This video was made by college students for college students to provide a basic understanding of lean accounting. You'll learn what it is and why it's so important. Let's get started. What is lean accounting?
You know, people say, what is lean accounting? Okay, and there's two elements to it. One is to apply lean concepts and principles to our accounting systems and make them lean. And then the second is, how do we report the information to the rest of the business in terms of what's been happening in the business? Okay, so it's very much a communications issue. Okay, standard cost management accounting systems try to communicate that information in a way that is arcane, that if you have a degree in accounting you might understand it, although there are lots of accounting people that I know that don't. And therefore when people look at it, they just kind of put it aside and they kind of take a deep breath and say, boy, I hope they know what they're talking about.
Lean accounting is a subject that people tend to mix up and confuse because they're two separate components. There's what we call lean cost management, which is accounting for lean, and there's lean accounting. Now, our current cost management systems were invented in the 20th century to basically touch labor, which is no longer the relevant cost component in manufactured products. Most of it is material in these days. So we have to have a different way of representing our costs for our products. Lean accounting, on the other hand, is using the same lean tools, whether they be Kaizens, 5S, setup reduction, for the accounting department to make it more efficient and more effective. Whether you're a service organization or a manufacturing organization, as long as you're applying labor, material, and overhead to the process of converting an activity, material, or service to a finished good, you're applying cost to it. And every company wants to understand accurately what the costs are for their product or service. Accounting for lean applies to really any business that has any cost structure. If you look at the cost structure today, it's probably 60 to 70% for material. Direct labor is a small number, maybe 10%, and overhead maybe 20%. So when you look at it, what we really want to focus on, what anyone would want to focus on, is our biggest cost component, which is material. Yet we have tremendous reporting systems for labor, which is becoming a smaller and smaller proportion of our total cost structure. But that's what accounting's been trained to track, to develop all sorts of productivity and efficiency measures, variances and whatnot, and we're losing sight of the most important component, which is material. So we kind of want to separate the things out, different cost components, and understand what's happening in our most important component, take labor and treat it a little bit differently, not treat it as direct or indirect, because what we like to think of is that they're all inputs to building a product.
Did you hear that? More emphasis on materials and less on labor and overhead. Also, lean accounting says we don't need labor or overhead standards and variances.
I think variances are and have been really that area of terror in accounting for both accountants and the non-accountants. For the first thing, many times they're aggregated so top level when you first see them and it's a big number, and then to be able to drill down into thousands of transactions, and you're always knowing, well, were those standards really good or not to begin with? And then you're trying to explain a variance from a standard that may or may not have been all that good. The timeliness is typically well after the fact, because most companies close their books once a month and look at all the information at that time. And if you try to go out on the floor and ask someone about transaction XYZ that occurred 3.5 weeks ago, they just look at you like you're nuts. You know, how can I remember that? Under lean accounting, when you don't have all those variances, although we do look at purchase price variances and still use standard for our materials, it's a lot more real time. You're looking at things, and we look at it every Monday morning for the previous week. We think that fits about the right amount of time. people have a much better memory. And first of all, we're not looking at variances anyway. We're looking at what happened the prior week. How many units did we ship? What cost did we incur? What issues did we have?
Sounds like traditional standard costing has not helped managers with their decision making.
What's happening today as companies move from traditional batch and queue to lean, and our standard cost accounting systems are giving off what I call false negatives, false negative messages, where something good happens in operations but it shows up negative in the standard cost P&L. That mirror that I'm holding up as an accountant still shows a reflection, but it's more like a reflection in a mirror in the funhouse when you go to a carnival. Okay? It's a distorted reflection.
Part of today's standard cost system is to take all your costs, and I like to use the word spread it to every SKU or end unit. And in that equation, we've got to take what we call fixed costs, which could be depreciation, property taxes, insurance, and figure out a way, some formula, to get it to every single end item we produce. And we do that in the hopes of getting more accurate costing. But it's probably the worst thing we could do for decision making, because whether we produce that item or don't produce that item, that cost is not going to change. And so we use the peanut butter approach. We spread all these costs across all of the SKUs. And typically the rules for doing that were developed years, if not decades ago, and it doesn't change. So in lean cost management, we don't do that anymore. We just track that at a very high level. It's not relevant for decision making, and we would rather understand our true variable cost of each and every product so that we can make better decisions, whether we in-source something, whether we outsource it, what we should do in terms of product development. We want to understand the true variable cost. That's the only thing that matters.
Whoa, no accounting for standards and variances, and little need for overhead allocation.
In my own past, we went from roughly an 85% allocation of cost, where the 85% of the cost of the product was an allocated cost, down to 15% of an allocated cost, which basically means the 85% is we don't really know what it is, but we got to put it somewhere. So 15% is the only things we really know what the cost is, materials and so forth, down to 15%. So now at the 15%, we know 85% of the costs we know are things that are resources truly consumed by that product as it's being produced. The allocation process, usually termed as overhead, is really just trying to take all the things associated with making any product, facilities, people, equipment, utilities, tooling, and on, and you're trying to put that into allocate it, putting against the products that are being produced, trying to align the resources, the cost to the product. When traditional manufacturing, non-flow or batch manufacturing, it's so difficult to do that just by the physical nature of the manufacturing process. That's why things tend to go to this allocation process, because it's a simplified way to put cost against it. The problem is it's completely inaccurate. So it gives you an inaccurate picture of what your costs are.
What brought us to lean accounting, actually, a big part of it was the overhead application factors that we had been using. We're an electronics manufacturing company, and we've made such gains over the years in using technology, different materials, and of course operational improvements, that our allocation-based direct labor hours was shrinking very rapidly. And while our costs were going up, and there really was no cause and effect to those. And so what you're doing is you're layering assumptions upon assumptions upon assumptions. Your three assumptions really are, well, what is going to be included in the overhead pool? How much cost are you going to be incurring in a period of time? Second assumption is, well, how do those costs relate to the different work centers? And then thirdly, what's the number of hours that you're going to be producing in a given period that you're going to allocate those costs to the products? And so you can see where it's layers upon assumptions upon assumptions. And anytime you have assumptions, they're typically wrong the minute that you make them. Under lean accounting, what I really like about that is that First of all, the costs are more specific and directly attributed to the value stream that you're using them for. So that right away has a better cause and effect. We only have one allocation in lean accounting, and that is an allocation to the value streams for space, for the space that they use. And once again, that drives behavior. When they understand they're being assigned that cost for the space, it behooves them to find ways to reduce the footprint of their operations. But versus traditional accounting, that is the only allocation that we do. One allocation, very simple, takes me a few minutes at the end of each month to do a journal entry and allocate those costs out. But every other cost is very directly incurred by the value stream.
With fewer allocations, month-end close and reporting is much faster.
What has become a fantastic innovation with regard to lean accounting is in value stream costing. What I see when I visit companies is that they've gotten away from the monthly periodic reporting and they have gone to weekly value stream statements. Now when you think about the impact of this, if we wait with bated breath for our P&Ls and other financial statements on a monthly basis to make decisions to see whether or not we're in control and what are we going to change, we really have 12 opportunities for change, and we have to wait for the impact of that for yet another month out. When we have a 52-week worth of information, not only do we get 52 opportunities to learn, but there are two things. There's the opportunity for rapid experimentation, because I can make a change now and I can look at next week to see if it was getting me there, and if not, I can redirect very quickly. And that's going to give you exponential growth. And there's a closer tie between cause and effect. A manager or a value stream team member is going to remember this week what decision he made and why last week that caused this result. So the learning opportunity that comes from a more frequent, plainer, simpler language is what is absolutely going to drive us to success.
Lean accounting provides relevant information more quickly, but what about GAAP?
You know, we've had companies that literally have taken their traditional P&Ls and we converted them to more lean-oriented P&Ls that are more plain speak, get more focus on the variable cost that people can affect, that kind of stuff. And so you can do that, and it's strictly in line with GAAP. You know, there's nothing counter to GAAP. Matter of fact, most of the time when the public accountants look at what we're trying to do, you know, they question it in the beginning because it's different. When you explain it to them, I've never had a public accountant say, oh, that's not right. You know, usually it's like, oh, that's fine, once they understand it. So it's really not that counter to GAAP. And most public accountants they might need a little prompting, can recognize that what we're trying to do is right in line with the 4 key tenets of GAAP, you know, including materiality. Don't worry about precision when accuracy is important. That's right under the guise of materiality. Conservatism, we're actually quite conservative folk in lean. The timing is probably the biggest one that we get tripped up on. But with lean, as we get better and better velocity of the product, timing becomes less of an issue. You know, you don't have to worry so much about matching revenues with expenses. Matter of fact, once we hit the month threshold, if we can have inventory turns of 12 or more, those timing issues almost become null and void. They're non-issues. Because unfortunately most companies see and report financials in a monthly bucket. So if we have the inventory turns 12 or more, you know, indicating less than a month, what's the issue of matching? You know, revenue and expenses, it becomes a non-issue.
To emphasize, when turnover is 12 times per year, there is no need to track every penny through work in process and finished goods. When we change from standard costing, we don't do it all at once, and we can use the current accounting system.
We really have to migrate from standard cost accounting from that to lean accounting or plain English accounting or whatever you want to call it. Okay? And you don't have to do it overnight. You can do it over a period of time. It's not It doesn't cost you a lot of money. You don't have to go out and buy new computer systems. You can do it with your existing. Your general accounting systems work fine. It's just a matter of having the courage to do it. I tell people what you want to do is migrate basically from standard cost accounting into lean accounting. And you can do that using the lean P&L, or the plain English P&L, whatever you want to call it, in parallel with the standard cost statements, so that people become familiar with seeing it. They understand that it's not a change in accounting principles, because if you look at the plain English P&L, the revenue is the same, the bottom line profit's the same.
A plain English P&L is essential for lean accounting and is more understandable for accountants and managers.
What you really need for decision making is to look at a simple P&L, plain English P&L, all right, that says, I bought this much material, I consumed this much material, I had this much revenue, all right, I had this much labor cost, so I had this material cost, this labor cost, I had, this directly attributable energy cost or maintenance cost, all right, to this value stream. And, so you put that all together, here's my revenues, here's my expenses, and here's my profitability for that value stream. It's a very simple, plain English P&L. And that's what you use for your decision making. Are you doing the right things? Are you doing the wrong things? Are you getting better? Are you getting worse? Right? And you don't get tied up in all of this stuff with the allocations and absorption and all that sort of thing.
Lean accounting emphasizes direct controllable costs, ones managers can do something about. As accountants, we need to think differently about reporting and analyzing information already in the system.
We as accountants we wouldn't be in this profession if we didn't like to crunch numbers. And we like rules and we like specific direction, but when we're in management accounting, we're trying to be providers of information that is useful for decision makers. We are producing a number, a bottom number, is not really our objective. Our objective is to try to give information that will improve business, that will help managers on the shop floor, speaking of a manufacturing company, improve their processes, and so that they know when they are improving processes. Ultimately, if you improve your processes and eliminate waste, that's how you're going to grow your business, that's how you're going to increase your cash flow and increase your profitability. And just crunching numbers is not going to help us.
Also, when you look at a product, traditional accounting might say it's not profitable, but lean accounting would say it is, and so you're really missing out on a great opportunity if you didn't see it that way. As a student, I think lean accounting is really important because when you go into the businesses, you can really impress them on the fact that you know these things, and the company that you work for might not be working under those circumstances. And if you come in knowing about lean accounting and knowing what it can do and why it's a great thing, then the company's going to see you as so much more valuable than other candidates for the position, and you're going to really do well and progress within your opportunity there at that company.
Let's summarize. Lean accounting refers to both streamlining our accounting processes and providing information that helps managers make the right decisions.
Lean accounting is fairly new. The word lean was coined in the 80s, and this